Happy Friday, friends. It's Jackie P, your CFP, back with another episode of Fact or Flop Friday, where I help you separate internet advice, the good from the bad. And I hope it's good, because I'm tired of seeing the bad. Low confidence here. Never trust a dry erase board.
If I had $100,000 to invest in 2025, this is exactly how I would invest. First, I would invest in a brokerage account because that's going to give me maximum flexibility. Then two, I'd borrow against the value of that account so that I can then invest in cash flow producing assets like real estate. Three, I would then reinvest that cash flow back into the portfolio so it gives me more capital to keep being able to do this strategy. And then four, I would absolutely rinse and repeat it.
So essentially what he was talking about in this video is using a pledged asset loan against your investments to then use that to invest in real estate, and then using that cash flow to invest back into brokerage account so you can borrow against it to invest in real estate and rinse and repeat. Now, the logic sounds good on paper if everything went the way it was supposed to. But for all those investors out there in the stock market and also in real estate, you know that the winds can change against you without a moment's notice. This is a very, very slippery slope and an easy way to get yourself in trouble because you're essentially over levered. The way a securities-based loan works is if you have $100,000, depending on the stocks, a firm can let you borrow sometimes between 50 to 70% of the value of the investments. So at $100,000, if you decided to max it out at 70%, everything is fine if the market goes up, but if the market goes down to 90,000 or lower, that 70% maximum is now hit. So then you will have to pay out of pocket to pay off that margin call or liquidate securities in a down market. Looking at most investors' history with borrowing and investing and how most folks are more aggressive when the markets are doing well, people could get themselves in a lot of trouble. And we've seen this a lot here at Liberty One. People get over levered, the market sells off for factors that they did not see coming, and then now they are basically without their shirt. So I don't want to say this is a flop because it is a strategy I've seen folks do. However, this is something I advise that you don't do unless you are an absolute professional. So this strategy reminds me of a quote, when the tide goes out, you will learn who's been swimming naked. As we've seen with a lot of bank failures in the past, or you'll see hedge funds that go bankrupt, people over leveraging themselves because they're overconfident in their knowledge and what the markets are going to do. So don't get caught swimming upstream naked. I know that's not a phrase, I made it up. I'm Jackie P, your CFP. I'll see you next week.